One of my channel members asked in the comment section of the video which one I like better, SoFi Technology stock or Affirm Holdings. Which one do I think is the better investment at current prices? And I thought that was a great idea for a video. So thank you for making that request. That's precisely what I will answer in this video here, comparing these two fintech stocks across revenue, profitability, return on invested capital, and then comparing them on valuation, measuring by the forward price to sales ratio, and comparing them using my discounted cash flow valuation models on SoFi and Affirm to determine which one I think is the better buy today. So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. Looking at their trailing 12-month revenue over the last couple of years, we see nearly identical numbers and trends. Affirm generated $2.5 billion in trailing 12-month revenue, while SoFi Technologies was almost there at $2.48 billion. SoFi Technologies is more of a diversified business. It generates revenue from lending to various end markets, including personal loans, home loans, and student loans, whereas Affirm focuses primarily on buy now, pay later. And so it's a more narrow-minded business. Now, depending on what you prefer as an investor, will determine which one of that kind of business model makes more sense for you. The lending business model, the bank lending type of business model that SoFi Technologies employs, that's only roughly half of its business now. SoFi Technologies also has financial services and technology that it's selling. So it's diversifying away from its lending business, which is good news for investors. If you're looking at a fintech company or a financial services company, the less dependent the company is on lending, the less risky that business is because you're not relying on the people to pay you back. Affirm Holdings, meanwhile, sells the majority of the loans that it originates, and the market for buying these loans is soaring. Lenders are very excited about giving these kinds of companies money, companies like Affirm and SoFi and Upstart and these other companies that generate loans, because lenders can earn rates of return upwards 10, 12, 14, 16% return on their money for giving out loans, which is, 3 times what they can get with the government bond right now at 5%. And so lenders are excited about this market, especially because unemployment is relatively low, consumer spending is still high, the US economy in aggregate is performing well, even though there's pockets of trouble. In aggregate, it's performing well. So in this environment, lenders are excited about this market. However, the flip side is also true. When or if the economy worsens or enters trouble, this market quickly dries up. Lenders anticipate the slowdown. When lenders start to see unemployment go up, they start to really constrict lending because they don't want to make loans ahead of an incoming macroeconomic slowdown. That's the time when the lending business is the most risky. When people lose their jobs, that's when the highest probability that they will default on their loan payments. If people are working, for the most part, they will make all of their loan payments, credit cards, car payments, home loans, everything. They'll make their payments. But when people lose their jobs is when these loans start to come undone. And SoFi and Affirm are in the riskiest part of the lending market. And these are loans with very little, if any, collateral. That's the riskiest part. If you're doing car loans and home loans, those are the safest part of the lending market because you have collateral you can go and repossess in the event of a default. So that's the overview we're looking at here with SoFi and Affirm. And if you look at profitability, they've both made huge strides in this regard. You can see a nice upturn here for both. SoFi is already profitable on the bottom line, 214 million in trailing 12-month net income. Affirm is making progress, but not yet profitable, negative 446 million on the bottom line. If we look at cash flow from operations to sales, we see a different story. Affirm is already positive at 21.71%, while SoFi at negative 47%. Now, cash flow from operations is a difficult metric to gain insights from with lending companies because the way they categorize these loans that they make, some of the loans that they make, they sell them to outside investors. Some of the loans that they make, they keep on their books. And so, depending on what they plan to do with these loans and the accounting treatment of these loans, you get sort of these mixed results from the cash flow from operations to sales. The big thing to remember with these is that the funding sources. SoFi has more diversified funding sources because it's a bank. It gets deposits from customers. So that's money the company can use to make loans. Affirm doesn't have that luxury. Affirm needs money from investors to make loans. And so if the investor market for lending dries up, Affirm, the amount of lending that Affirm can do will slow down as well. SoFi, it will also slow down, but not as much as Affirm because SoFi will have deposits from customers that it can use to make loans. It's allowed to do that. And so it's a bit more diversified in that sense. All right, now that we looked at some of the business performance metrics, let's look at valuation. First, with the forward price to sales ratio. Measuring by this metric, you see Affirm is a little more expensive at a forward price to sales of 5 compared to SoFi with the forward price to sales of 4.5. You can see their stock prices, their valuation have been moving in unison over, I would say, the last year and a half. See, they've both risen together and they both declined together because, as I mentioned, they're both exposed to similar end markets with those lenders and their appetite for purchasing these loans that they are making. SoFi, I mentioned, is more diversified, but it's still dependent very significantly on those end markets. And so as those end markets change and fluctuate, the prospects for these companies change and fluctuate, right? And then looking at my discounted cash flow valuation for Affirm, the intrinsic value per share I calculated was $81 and the current market price is $60. So Affirm is meaningfully undervalued according to my discounted cash flow valuation. Similarly, when I did a discounted cash flow valuation for SoFi, I found it's worth $21.38. Current market price is $14.60. So also significantly undervalued according to this metric. Now, to make the decision, which one do I like better, Affirm or SoFi? It's close. I like both of them. I have both of them rated as a buy. But if I had to pick just one of these stocks, I would pick Affirm as the better stock to buy in this scenario. Affirm's growth prospects, I think, are better than SoFi because of how it helps both sides of the transaction. And that qualitative factor where merchants are also going to be very interested in helping Affirm grow because they help facilitate transactions that may not have otherwise happened. If you can buy now, pay later, you might buy something that's $200 when you otherwise may not have. And so those qualitative factors shift me slightly more towards Affirm as the better stock to buy in this comparison. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.